From LPL Financial, welcome to Market Signals. I'm your host, Ryan Dietrich.
Welcome to the latest edition of the LPL Market Signals podcast. I am Jeff Buchbinder here, your host for this week without Ryan Dietrich. We're going to try to bring you a great show, even in Ryan's absence. He'll be back with you next week. I am thrilled to be joined by my esteemed colleagues, Marc Zabicki and Lawrence Gillum. Gentlemen, how are you doing today?
Very well, Jeff. Good to be with you.
Couldn't be better, Jeff. Thanks for asking.
Great. So thanks for joining in here. I think you're going to get a little higher energy out of us today because we're actually recording this around lunchtime. Usually we record pretty much first thing in the morning. And I don't know about all of you, but I bring more energy later in the day after I've had a meal or two. So we have a great show for you today. As we move through the deck, here is what we're going to cover. It's been first of all, been an amazing week in terms of the market rebound last week. And this week is just an amazing week in terms of all the stuff that's going on. We're going to start by just reviewing our weekly market commentary, which is about the biggest surprises of the year. We have 6 of them to be precise. Then we're going to preview the Fed meeting. One of the reasons why it's a big week. Lawrence is here, our fixed income strategist, to talk Fed. Next, it is the busiest week of earnings season. About 180 S&P 500 companies are reporting this week. So certainly we're going to get a real good idea of how well companies are going to be able to manage some of these cost pressures that we've been seeing after we get all of those reports in the books. And then lastly, we have GDP this week, as if it wasn't a big enough week already. So we'll hear from Marc in particular. He's done a little bit of a deep dive into GDP, and we'll bring that to you. So why don't we start with Lawrence? Certainly yields have been getting a lot of attention and lead us in the list of surprises this year. Lawrence, how have yields surprised you?
Thanks, Jeff. Yeah, they've actually surprised us a couple times. So coming into the year, we expected yields to move higher. We started the year around 90-ish basis points and on the 10-year Treasury yield. Given the outlook for growth and inflation expectations, we thought the 10-year Treasury yield could move higher. And the first surprise is that it moved meaningfully higher than what we were expecting over the course of a month and a half. So within February and March of this year, yields really ramped up pretty quickly and got to as high as 1.75% on the 10-year Treasury yield. So that was higher than a lot of us were expecting at that time. So that was certainly the first surprise. The second surprise then has been the fact that yields have drifted lower since that 1.75% high that we saw back in March. We're about 125 on the 10-year currently, so we're still up for the year about 35 basis points from where we started. But certainly, given the growth expectations, the inflation expectations that we have, we would expect interest rates to be higher than they are currently. There's a lot of factors that we think that have contributed to those lower rates. We probably are past that peak inflation and growth expectations, so those have come down. A lot of foreign interest in our markets have kept Treasury yields or Treasury securities well bid, I should say. And then, just the economic concerns about the impact of the Delta variant recently have put investors back into the Treasury market as well. So the Treasury yield, the Treasury market has surprised us twice this year. So who says bonds aren't exciting?
Yes, and also, Lawrence, the bond guy always goes last. But how about this? We put you first this time.
I love it.
So probably should have sequenced these in a little bit better. But next is stocks have been strong and calm. We thought stocks would be higher this year, Marc. We certainly had an optimistic forecast, but I don't think anybody expected us to be up 16% year to date in July. So talk a little bit about how the stock market has maybe surprised you this year, Mark?
Yeah, I think surprise is the optimal word. We knew it was going to be a positive year for stocks coming off the kind of the or during the post-COVID recovery. It's probably a little bit more robust than I think we all thought. I think the expectation now amongst folks here at LPL Research is that we are likely going to get some bouts of volatility. We haven't really seen that much in the first half, so that makes us kind of raises our antenna for that volatility that may occur in the second half. But I think as we walked into 2021, I think the expectation was for kind of high single-digit gains in the S&P 500, for example, and you already stated that we've exceeded that, and as a result of the strong equity market and strong credit market, frankly, we've taken a little bit of some logs off the fire here from a portfolio management perspective. So expecting some additional volatility, but we have to tip the hat to the equity market and equity market participants for a rather robust start.
No doubt. The strength of the economic recovery and the earnings rebound certainly have fed into a really strong year for stocks. Those of you watching on YouTube can see the chart of the S&P 500, and we are at a new all-time high. To get to that high after a huge drop last Monday, took 4 straight up days, including a pretty big up day mixed in there. So we had to storm back from that down day and finish strong. But here it is, yet another all-time high. So thanks for that, Mark. Let's go. The next one's China. The narrative coming into this year and the start of the Biden administration was about how he potentially was going to get easier on China. And maybe that could create a better investing environment for emerging markets, China being about 40% of the emerging markets index. But it really hasn't played out. The tariffs have been maintained. Certainly, we've seen increased tensions around some of the human rights abuses that ties into the Hong Kong situation. There are a number of examples of cases where it's clear that that narrative, frankly, was probably misplaced. So U.S.-China tensions, actually, they were on display just over the weekend here, and I can bring in either of you guys comment on this. Some senior trade officials, foreign officials from the U.S. were over in China, and frankly, based on the headlines I read, they really aren't playing nice. So there's certainly a lot of tensions and some tough talk.
Yeah, I'll say this, Jeff, that I think that the political tensions between the U.S. and China, no matter who's in the White House, is probably going to be an ongoing thing. I think the question is just degree, right? And as you stated, I think most market participants, kind of expected that Joe Biden would kind of ease up on the gas a little bit, the gas that Trump clearly was applying during his years. But he really hasn't eased up on the gas that much with China, and the relations with China have kind of really deteriorated over the last, call it, 4 to 6 years, for example. So as the two 800-pound gorillas kind of battle it out for their rightful place in the jungle, if you will, between the China and the U.S. I think I would expect that the tensions to continue, and again, been a surprise so far.
Yeah, I think that's a good way to put it. I mean, pretty much all of us expected the relationship to continue to be tense, but really, in terms of degree, it just hasn't let up, and in some ways, it's even gotten a little bit tougher in terms of the U.S. rallying the international community to apply more pressure. So that'll certainly be important to watch, and we've seen that in the in terms of the underperformance of emerging markets, largely China. So let's turn to oil next. We have oil back in the $70 range. Frankly, I was surprised at how quickly oil blew through the 50s and 60s, and did run into a little bit of resistance in the 77 range. That may be a tough price to break through. But frankly, that strength has been surprising to me. We all knew we would get a little more supply as prices go higher, but that supply, both domestically and internationally, has been a little bit slower to come through than we anticipated. And then the demand, frankly, has been remarkable. You can look at some travel data. People are moving around as much as they were pre-pandemic. And the demand for oil, which of course is largely tied to mobility and travel, is very strong, and I think surprised us and frankly a lot of oil companies as well. So yeah, Marc, what are your thoughts on oil here? Do you see this this run kind of stalling out here, or do you think oil can make another run higher on the strong demand?
Sure. I think we've recently recognized a little bit of a dip in oil, but that's kind of, we've recovered off of those recent lows. Several moving parts here. I mean, you stated in terms of the demand, I think is relatively robust. All while where supply is continuing to kind of be restricted just a little bit. Although OPEC and OPEC plus, countries have kind of raised their supply, and they plan for more supply in August, as we understand it. U.S. supply has not been that great, and demand certainly has been outstripping supply in many instances in aggregate. I think if you've traveled along our interstate highways, you can kind of get a sense for the demand that we've seen. We're not expecting that to change in terms of the demand, at least for the second half of this year. Of course, I think people are excited to kind of get out and about a little bit, and rather than choosing airline travel, you have a lot of folks choosing automobile travel. I think in terms of the price itself, I think we have to be cognizant of the $75 level on oil, as we're bouncing around $71 today. That was a recent high, and so that'll be a good number to focus on. To the degree if we can break through that technically, then obviously we've got some room to go higher. But should we stall and perhaps break down at the next ascension of 75, it'll be something to kind of keep an eye on. So we're watching $75, I would say, as a near term resistance point over the next call it a couple months.
And for now in LPL Research, we do like the energy sectors. We think there's some opportunity for the stocks to play a little catch up to the commodity, but based on the recent volatility, certainly that is a sector that you might say is kind of on our watch list. So we'll keep paying close attention to oil. Something else certainly we're all watching is growth value. This is tied to yield. So Lawrence, we're counting on you to get yields a little bit higher for us, and that could potentially help the value stocks, because recently it's really been about growth. This is just a relative strength of growth versus value, and you can see after a little bit of a 6-month roughly period of value outperformance, growth has stormed right back and is kind of eating away at all of that value outperformance that we got last fall and into the early part of this year. So I think the key question, of course, as it always is with investing, is where do we go from here? So Marc, I know you have some long-term perspective on this. So give us your thoughts on growth value here from kind of a short-term, long-term.
Yeah, I think short-term we were probably surprised at the ability of growth to kind of bounce back, versus value, and it had been enjoying an overweight to value through the most of the first half of the year. Value has rightly come back as the economies are expanding. Long term, if we look at the next chart, Jeff, I think we're talking about an imbalance that's still present for us long term, and this is something that we look at from an asset allocation committee perspective that really kind of helps set the stage for us in terms of the way we think about growth and value. I mean, you can argue that the growth companies are perhaps the more innovative companies, better returns on equity in general terms, perhaps, kind of better profitability overall. But when you have this type of imbalance between the S&P 500 growth index outperforming the value index to this degree, you kind of have to ask yourself, is it different this time? Or are we still expecting, that old adage that, we're going to get a reversion to the mean? I would lean toward the latter at some point. We would get a little bit more of a reversion to the mean. We are modestly overweight value today because we think that's going to perform better than growth as we continue this economic recovery. And we're modestly overweight value because we think there's probably some air pockets within growth that, should we get a correction of some sort, maybe the second half of this year, we may feel that more in growth than in value, perhaps due to the air pockets and due to the higher Ps that you're seeing in growth as a result of this type of imbalance in performance. So this is really like a long-term look. Yes, today, slightly value or slightly overweight value versus growth. The longer term, this kind of puts it into perspective as to where you should be. And if you're overweight growth today, you're probably assuming a little bit more risk than perhaps you should be. So this is just kind of a long-term way of thinking about the trade-offs between growth and value.
It makes a lot of sense certainly to me to lean into value a little bit, given this chart. And if you translate performance into valuations, it looks even more extreme. Frankly, the relative valuations of value stocks relative to growth stocks are about as cheap as they ever get. So, even though the growth fundamentals, particularly tech, are very strong, we're going to get all the big cap tech results this week. Frankly, all the FANG names. So it's a huge week for tech. It's going to help us gauge the direction of those stocks. But this could potentially start the transition away from the pandemic winners. It's going to be tougher for these companies to show the same kind of growth. They're still doing well, and you still want a lot of them in your portfolios, but it's going to be tough to comp off of pandemic levels of growth, which are just frankly meteoric for a lot of these big tech names that have benefited from stay at home and work from home. So I guess that's a long-winded way of saying the bar is high. So last of our 6 surprises has been earnings. I follow earnings really closely, so this might be my biggest surprise, frankly. We came into this year, with the consensus number under $170 a share in S&P 500 profits, and now we're at about 195. This is extremely, extremely rare. In fact, typically estimates fall about 10% during a given year, and now they're up 14% or so year to date. Just remarkable. To put this into perspective a different way, how strong earnings have been, we're actually now about 20% ahead of the pre-pandemic peak in earnings. So if we deliver these estimates, if the estimates come through in 2021, we'll be 20% above pre-pandemic highs in S&P 500 earnings, which is just remarkable. This earnings season is off to a great start. You're looking at our earnings season dashboard for those watching on the YouTube channel. The 85% beat rates for earnings and revenues, those would be all-time records if they hold. We were looking at 64% earnings growth when the season began. Now we're tracking to about 75, and that only includes about a quarter of the results. So it is still quite early. We always follow estimates, and they are inching higher, which is great to see. So I think you'd have to call this a great start and comparable to the great starts we've had to the last few earning seasons. And with valuations a bit elevated, the earnings really need to come through to drive the next leg of this market rally higher, and we think it will. So just you really got to tip your cap to corporate America. They have really managed these cost pressures incredibly well. We'll learn a lot more about that when we get representation from other sectors. It's been mostly financials, but we expect generally that story to continue, that companies are managing these challenges really well. So gentlemen, anything else to add to that before we move on to the FOMC? Or should we keep rolling?
I just a perspective on earnings. I mean, you use the word remarkable, Jeff. It certainly is, and it's one of the reasons I think investors have been ready, willing, and able to kind of push money more toward the equity market. Certainly, U.S. corporations have kind of backed that up with results which have indeed been outstanding. As we recover here, and it's as we all know, it's what have you done for me lately, and we're expecting U.S. corporations to kind of answer that as we continue to move through Q2 earnings season results here, and then it'll all be up to what they can do in Q3, right, Jeff?
Yeah, that's right. We've actually gotten 12 companies provide guidance for Q3 already. 8 positive and 4 negative, which is a really good ratio. We've been doing that for the last few quarters, unusually strong, and hopefully that continues. So guidance will be watched closely. All right, we're back to the Lawrence Gillum show. So it's a huge week of earnings. It's also a huge week because we get the FOMC meeting on Wednesday. We didn't expect too much interesting out of the FOMC last meeting, Lawrence. It was a little more interesting than I think we thought. Might we be surprised, and could this one be a little more interesting than we expect?
Never say never, but yeah, last month's FOMC meeting was a bit surprising because of some of the economic releases as well as the dot plot releases. We don't get that for this meeting, so unfortunately we won't spend a lot of time talking about dot plots in our blogs and on our calls. So I'm sure a lot of people are upset about that, but we are expecting some additional language released from the Fed in terms of tapering. I think that's going to be the big topic of the meeting this time around. And tapering, just as a reminder, the Federal Reserve is buying $120 billion of bonds every month. 80 billion of that is in Treasury securities, 40 billion is in agency mortgage securities. They've been doing that since March of last year. So they've been providing this emergency level monetary accommodation since then. So there's a lot of folks both on the Federal Reserve Committee as well as market pundits and investors believe that is no longer necessary given the growth of the economy. So Chairperson Powell has reiterated that the substantial progress goal has not been met yet. So we don't expect them to make any big news about tapering, only that they've started to talking about tapering, just to kind of move that process a bit along. Certainly don't expect anything in terms of interest rate hikes. The market has pushed back when the Federal Reserve will start hiking interest rates, short-term interest rates. It looks like the beginning of 2023 is now the new kind of market expectations for interest rate hikes, which is in contrast to kind of what so the market about a month ago was saying that late 2022 was when the market would, or the Fed would start raising rates. But with the Delta variant and maybe an expectation of slower growth ahead, the market's pushed that off a little bit. So we'll see if Chairperson Powell says anything about tapering or the interest rate hikes in the future, and see if that market expectations move at all. Certainly we don't expect them to, but it should be, knock on wood, a pretty mundane meeting. We'll see how it goes. I'll certainly be watching, and then the press conference afterwards on Wednesday afternoon with Chairman Powell will be interesting to us Fed watchers anyway. And but again, we don't expect fireworks. Our view is that The tapering announcement will happen either August or September. It's looking more like September is when the Federal Reserve will start talking about their plans to taper, with the actual tapering happening sometime next year. But yeah, to your question, hopefully there's no fireworks, because I think that's going to just provide a lot of volatility to markets if there's something that we're not expecting.
Best guess, Lawrence, just on the tapering aspect. Let's say in September they do announce some type of program that begins perhaps in early 2022. What would your expectation be for what that tapering would look like? You mentioned we're buying $120 billion worth of securities. What do you think they're going to kind of taper to? What kind of level of securities would they take that down to, that level of buying, that is?
Yeah, so the goal is to reduce that bond purchasing completely over the course of, let's say, a year. There's been discussion about should they taper mortgages, agency mortgage purchases first, or in a greater amount, so reduce the mortgage purchases first. There's been some concern about the strength of the housing market, and if the Fed is providing some of that fuel to that fire. So there have been some Fed governors talking about reducing those purchases first and getting out of that market altogether. And to be honest with you, Chair Powell hasn't had great responses as to why they continue to buy mortgage securities. His response has generally been, that's the way they did it last crisis, which was the global financial crisis, which had more of a housing element to it, that you needed to support that market. Whereas now, given the robustness of the housing market, you don't really need to continue to buy those mortgage securities. So based upon history, though, it looks like they'll do a pro rata reduction in treasuries and mortgages over the course of the year. But since they're buying fewer mortgage securities than they are treasury securities, they'll likely get out of that mortgage market before they get out of the treasury market, is kind of my best guess.
Fair.
And then before too long, we'll be breaking out our charts showing you how stocks do during Fed rate hike campaigns and how bonds do during rate hike campaigns. And certainly, back to you, Lawrence, there's been a lot of attention on the credit markets, right? And so, the Delta variant certainly a concern, and there's, some have concerns about peak growth. We're not concerned about that so much, but we understand those concerns are out there. When you look at the credit markets, are they continuing to tell us there's nothing to worry about, or are we starting to see some ripples there?
We did see a backup in spreads, and again, spreads are just that compensation for owning these additional riskier bonds above what you would earn in treasury securities. So we did see a backup in spreads last week, but then we saw a recovery. I guess about 75% of that widening was recovered over the course of the week last week. So the credit markets remain benign. They're not as concerned. I guess there's been some concern about the bond market. We talked about yields earlier and how they continue to move lower, which generally is there's a sense of worry or concern if interest rates move lower, right? That's typically a risk-off sign. But because we haven't seen that same sort of sentiment in the credit markets, we don't think that there's a recession on the horizon, for example. I think we think it's just there's a lot of liquidity in the system, and everything is getting a bid these days. Credit markets, treasury markets, equities as well. So the credit markets aren't telling us that we need to be worried just yet, but certainly we're watching.
Great, thanks for that, Lawrence. Why don't we move on to the last part of our agenda, which is GDP. Here again, it is just a massive week for big economic data and market events. And GDP is the last one. So Marc, what should we expect? I know the growth expectations are pretty big.
Yeah, I think, as Lawrence talked about, Wednesday we get the FOMC, and then on Thursday we do get US GDP numbers. As I check the Bloomberg now, we're looking at an 8.5% consensus estimate annualized on a quarter-over-quarter basis. What you see in front of you are actually year-over-year numbers. So, regardless of whether it's year over year, or whether it's quarter over quarter, there are going to be robust numbers coming out of the U.S. or coming out of the entire globe, as you can see for Q2, as as all economies, open up, post-COVID. Now, I put this together just really for some perspective in reality. And we're all enjoying some robust growth, not only from earnings perspective, but also GDP, stock prices. Spreads are tight, as Lawrence mentioned, and we as an asset allocation committee at LPL Research have kind of taken a few logs off the fire, as I mentioned early in the opening remarks. And that doesn't mean we dislike the equity market or we don't believe that you should be overweight equities versus bonds. We do, but we are expecting that tide to turn a little bit, at least from a GDP perspective. And I think this table kind of gives you some indication of how growth is still going to be rather attractive, but it's in fact going to decelerate on a quarter-over-quarter basis. So that perspective is essentially the message here. We talked about a longer-term perspective, I think, and when we talked about growth and value, and if we talk about a little bit of a longer-term perspective in U.S. and global GDP, I think you have to kind of take a look at this chart. Because the capital markets is a forward-looking mechanism, right? And you kind of have to ask yourself, what kind of reaction are capital markets going to have to an eventual deceleration in growth for U.S. and other countries? Again, we think the equity market's going to outperform in the near term, and our forecast says so. But you should just not necessarily be adding logs to your fire. You should be managing your portfolio to the degree that it's adequately balanced, the risk and return that is specific to your personal risk tolerance. So we are expecting a good Q2 number. Q3 numbers, as this table shows, are likely going to be good as well. But sometimes we have to kind of step back and take a look at the trend in those numbers, or the potential trend of those numbers, for a better look overall as to what may happen in the quarters ahead.
Yeah, Mark, I thought this was really interesting. First point, you're seeing deceleration from 13% to 3% over a couple of years in the U.S. That's certainly noteworthy. If these are, of course, forecasts, but that's the direction where this is going. The Eurozone line, actually, in a few quarters, the Eurozone could be growing faster than the US. They're coming out of the pandemic later. So that's certainly something that could help those markets perform better a little bit down the road. And then, the BRICS, the emerging markets, right now, their growth doesn't look so great compared to the US. And so just like Europe, we might have to wait a year before the BRICS are outgrowing the US. It's a really interesting dynamic that certainly, flips the couple of decade trend that we were used to on its head. So we're generally investing kind of in the same way, favoring, mostly the US, getting a little more interested in Europe, and, getting a little maybe less interested in emerging markets. So interesting analysis there. So that's the end of our agenda. So I think we'll go ahead and wrap up, although I have one last question for both of you guys. I want you both to answer this on a scale of 1 to 10, with 10 being the most scared. How scared is Ryan Dietrich right now, hanging from a zip line 100 feet in the air, attached to some branches? Mark?
I would say he's probably about a 4. Ryan Dietrich is typically not a scared individual when it comes to that. So he gets up in front of hundreds of advisors every day and does the Market Signals podcast, or at least every once a week, that is. And I'm standing in here for the first time, and I'm a little scared myself, and I know Ryan Dietrich's not. So a 4, a definitive 4.
Right. Lawrence, you're going higher than that, aren't you? I know.
I agree with Mark. I mean, the guy's fearless. So I'll go with I'll go with a 5, just because do the prices right one up on a one number, but And no, Ryan, I see no fear in Ryan's eyes ever.
I tell you, his kids are zeros. I know they aren't scared. In fact, they're probably up there, standing up, getting on top of the lines, ditching their belts. That let's hope we should worry more about them maybe than Ryan. So anyway, hopefully the Dietrichs are all having a great vacation. We have seen some pictures. Maybe he tweeted some. So Ryan, we miss you. Come back soon and in one piece. So with that, last thing, well, we covered everything that's really happening this week, and it was big. I mean, there's some other reports, second tier economic data like durable goods, but really nothing that's going to get the attention of GDP, earnings, and the Fed. But last thing, we do have some more horse trading in Washington going on, and they may come to an agreement on a bipartisan infrastructure bill. That we'll have to watch. No matter how this plays out, we do think we're going to get a couple trillion in spending that passes Congress this year. It's just a matter of how many bills it takes and what method. So we'll certainly be watching Washington closely as well. So thank you for joining us, as always, on the latest Market Signals podcast. Thank you to Lawrence Gillum, fixed income strategist, Marc Zabicki, director of research, for jumping in. It was fun. I think we are going to please Mr. Dietrich, but certainly if he's not happy with this for any reason, we'll go back to the drawing board and we'll do something different next time. So next week, we will not be doing our regularly scheduled podcasts early in the week, but later in the week, we'll be bringing you special podcasts from the LPL Focus Conference. We look forward to seeing many of you there. Thanks, everyone.
This material was provided by LPL Financial, is for general information only, and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecasts set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer. Member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.